And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. ETFs are often associated with buy and hold strategies, but a younger generation is starting to use ETFs in a more active and tactical manner. Let's talk about it with Webull CEO Anthony Denier. Andrew McCorman is the managing director at Wallace Capital, and Harry Witten is the head of ETF sales trading at Old Mission Capital. Anthony, Webull is an electronic platform, has a lot of the demographic characteristics of Robinhood. I see average age 30 years old, 7 million accounts. Before I get to ETFs, tell us how your investor base traded on Friday, since that's the topic du jour. Were they buying or selling? What were they buying or selling?
Yeah, we saw a bit of both, but I was really surprised to see the strong buying demand, because this retail investor right now is extremely bullish on this market, I think for all the right reasons. So they saw this more as an opportunity to actually buy some discounted names, and not knowing which names to actually get into can be difficult when the market's moving so aggressively. So we saw a lot of buying in broad index ETFs, right? SPY being our most popular, a lot of heavy buying there, and our momentum traders we're also utilizing the inverse ETFs, which was pretty surprising, trying to get that momentum on the downside just with using a long account.
Yeah. Now, Harry, you run a big ETF market-making desk. I often talk to you about trading trends. What did you see on Friday, and what are you seeing today in terms of who's trading what?
Hey, Bob. Thanks for having me on. Yeah, it was a super busy day. Everybody thought we were going to be sitting here doing some online shopping, waiting till 1 o'clock. But we traded more on Friday than any normal day last week, and we saw a lot of selling of high yield, a lot of activity in the international space, emerging market space, which Old Mission specializes in, and just as Anthony said, it was just a lot of buying later in the day going into the close, which was early on Friday at 1 o'clock.
It's remarkable how much has reversed, Andrew, from Friday. And now you, Andrew, run a big institutional trading desk. A lot of it's ETFs. What were you telling clients Friday, and what are you hearing from them today?
Yeah, it's funny, the two different generations, right? We have our tactical, old school, reduced risk ETF shops that, of course, Friday, those triggers start to happen. They start to go off. They start to get close. That's, as Harry said, we had some high yield sellers as well. And they're kind of precautionary, right? Now they might wait a couple days and jump back in. But with this younger generation, I got to tell you, I'm getting into my 20-something plus years in the business, I've never seen a group more resilient. Of course, they don't know a loser yet, and that's a factor, but they're very resilient, very strong. They're buying on dips, just like stronger hedge funds, where it's very unlike a retail audience. You just don't see that panic. Of course, this has been the trend, right? The 1 or 2 day sell-off, and then it pops back up.
Yeah. Now, Anthony, you've told me ETFs are still a fairly small portion of the assets of your clients, but there seems to be two groups here. Some own plain vanilla ETFs, like the S&P 500 or the NASDAQ 100. They also like Cathie Wood, no surprise there. But there's also a more active a group of traders at Webull that have a penchant for using leverage and inverse ETFs, particularly the ones that leverage returns on the NASDAQ 100. They seem to really like that, and even the VIX as well. Why is that group so interested in leveraging, for example, the NASDAQ 100?
Well, if your viewers aren't aware of Webull and how we kind of differentiate our platform, we do have very similar demographics, like you noted in the beginning, to Robinhood in terms of average age, average account size. However, the one differentiating factor that we may have left out is we have very active traders, right? And our traders are very quick to take positions. They go in and out of positions very, very fast. So when we see our active traders, which is a big portion of our users on the platform, they tend to be not able to get access to some of those traditional leverage tools, right? I mean, I'm talking about margin in a retail account, right? You need to have $2,000 or more just to qualify for Reg T. A lot of our users don't even have $2,000 or more. We're talking about millions of them. Also, they may be too young to have the proper investment experience to get access to the options market, right? So that's another sort of speculative or highly leveraged security that they don't get access to. So they have flocked to these leverage ETFs. And you mentioned TQQQ. I mean, that by far is our most popular leverage ETF that we see our heavily speculative active traders getting into day in and day out.
And that's, of course, the TQQQ is the ProShares Ultra Pro QQQ. That gives you leverage, of course. and when you own the triple Qs. You know, Andrew, I can't help but notice that. Like Robinhood, these are small accounts, as Anthony said, $4,000 on average. But what's the future here? Isn't the assumption they're going to grow, and as long as the market continues, they'll continue to deposit assets? Power.
These are the same people that exhausted the shorts in GameStop and AMC. They gave up. They go, I'll go short something else, right? So they have a lot of power and resiliency, and they're growing. And the ultimate sign is you have billion-dollar, very successful companies and new companies. For example, Direction, you know, multi-billions of dollars AUM. They are changing their marketing to really focus on these people. And again, their products, right? Imagine going, I'm going to the Pittsburgh Pension Dinner next week. Imagine going that and saying, I want to tell you about this fallen knife ETF from Direction, and I'm also going to tell you about the psychedelic ETF from Defiance, right? They would be like, are you crazy? But we're talking a lot of money going into these products. I also want to note, and I'm very proud of Direction and ProShares for education. If you look on their websites, the fourth button is education. And I hope at Webull you're doing the same thing, just explaining it to everyone, even for this audience, to know the effect of long-term holding these assets. Not saying they're doing that, but if you're long-term holding a triple ETF and it goes the wrong way, you know, that can have some unpleasant results.
Yeah. So, Anthony, what about that education aspect? I mean, remember, we all look like geniuses in an up market. What happens when all of a sudden the market drops and, you know, it doesn't work just buying endless call options, for example? That stops working. What are you doing to prepare and educate your investors or the people who put their assets on your site?
Education is one of the most focused and talked about things with platforms like a Webull that serves a younger and a newer investor, right? So, you know, the traditional way of educating is maybe having like a table of contents with a glossary, and it kind of reads maybe like an encyclopedia on a typical brokerage website. And, you know, we have those types of things, but we found that that doesn't work, right? Just because you build a library does not mean that students are going to show up and start reading all the books on your shelves. What we have been doing, and this word gets used very negatively in the press, is we've been gamifying the education, right? We've been taking those nuggets of facts. What is a leverage ETF, right? What is an inverse ETF? What are the risks associated, and put them into easily digestible kind of bullet points and snippets, short videos or animations, or even have an interactive social media questionnaire, right? Now, if you think, you know, what's more risky, you know, a short duration call on a Thursday afternoon or a, you know, triple weighted ETF. You know, I'm just had like polls like that to get our customers involved to actually look up the differences of the risk between the two. So this is a huge undertaking, not just for Webull. I'm speaking actually for the whole kind of mobile first retail industry, where we've actually been having roundtable discussions together, figuring out the best ways to educate our clients. And, you know, some of our peers, Robinhood's doing a really good job of it on social media, I think, of getting that education out there first. Fidelity's starting to do it as well, and using this idea of gamification to get educational content into and consumed and understood by this new demographic, right? We consume, as a society, we consume information much differently now than we did just 5 years ago. And I think the education factor that a brokerage platform gives out to their customers also has to evolve with that new way of consuming that information.
I've often compared you to Robinhood, but I wonder if that's a little bit unfair. I mean, you've often tried to sort of say, all right, we are sort of like Robinhood, but we're not. How do you differentiate yourself? I mean, you've said before that your customer base consumes more research, for example. So is it more fair to compare you to, I don't know, Thinkorswim customers or something like that? How are you different?
So if you were to compare our order flow versus, say, another brokerage order flow, we more mimic a Thinkorswim type of customer, right? A more advanced, that's utilizing charts, utilizing back testing, utilizing different, you know, analytics and indicators to make an entry point and exit point decision, where, you know, that's not so much the case on some of the simpler platforms that are out there. And the fact that we are a mobile first solution brings our demographic into the same world as a Robinhood. So we often get kind of, you know, grouped up with Robinhood. It's, oh, they're just a different form or a different name of Robinhood, when in fact, our customers' profile, although on a media spreadsheet may look the same in age and affluency and demographic, but when it comes to actually the educational aspect of our investors, they're much more intellectual and experienced in what they're doing, to the point where we often say internally that Robinhood is our customer's first account and Webull is their second, because they graduate from a simple sort of make it easy to trade, don't get too deep in it, to I want to get deep in it, I really want to nerd out on this, and I want to learn more and learn how to do it better.
So, Andrew, do you buy into this narrative that suddenly we have a smarter, more intelligent investor base that is really interested
Absolutely,
in more
because
knowledge?
they're talking about options. Like you said, if they're talking about options, they're more advanced. If they're talking about lever, they're more advanced. I love that they want to learn that. The ETFs will not grow at these platforms substantially, I think, until you have a losing time frame. Like, for example, a Peloton, right, had that violent move down. When that kind of happens, and now hopefully this thing with COVID, this latest, the Omicron isn't a big deal. If it is, and we go back to work from home stocks, I think some of this audience could then be like, okay, how do I not get involved in this single stock risk? And then there's WFH, work from home, from like a direction. Or there's the moon, where now instead of just picking the one, I mean, you've seen them flock to Cathie Wood. So now the new issuers are putting these out. But as long as they're doing this work on this website, I would think that they're going to stick to single stocks. So they're putting that work in to not achieve beta. They're putting the work in to achieve alpha. And they've known alpha for 2 years, right? So I love that they're getting educated. I have not seen it. I've grown up with many of my customers. I've not seen such an intelligent investor base. And let's be honest, when they get to 30 years old, when they get to 35, they start making real money. They're already going to be seasoned. It's going to be a big lift for the market when this starts happening, when they get a little older and have even more money to invest.
Yeah, Harry, listening to Anthony and Andrew, you can't help but think that for these young traders, it's almost like they're taking some risks. Maybe it's their play money. But as they get older, the narratives here seems to be the investments are going to change, the assets are going to grow, and you'll see more and more investors put their money into plain vanilla ETFs, for example. Do you buy into this kind of narrative?
Yeah, totally. You think they're probably their primary account is their 401k, and this is their money. It's part of their savings. They're using it as their play money. I don't think you should overlook the fact that fractional shares have really changed the business. It used to be, you had to go out, you had to do a minimum, you had to buy X amount of shares at a brokerage firm. Now you can go in, you can put $50 in to buy, a share of Tesla or part share of Tesla. I think it's really important, and it also gives you a way to diversify the account. And I think, as Andy said, as these accounts get more mature, you're going to see us start diversifying into more of the pure bread and butter ETFs with the alpha generating areas on top of it.
It makes total sense to me, Harry. I mean, in terms of what they own here. Cathie Wood, they love Cathie Wood. That makes sense. Cathie Wood's a hero amongst some of this group. No surprises there. I think Tesla is the #1 stock held by people under 30 or something like that. She is a leader in Tesla, so they tend to follow it. So Harry, nothing I'm seeing here is shocking to me particularly.
No, it all makes sense. You have to say, look what happened during COVID when people were from home. You saw a massive uptick in people doing online investing. ETFs were part of it. Individual stocks, as Andy said. All of the GameStop type stocks, Avis, Hertz, all of that stuff that's going on in those marketplaces. It's just the future. The future is these types of platforms.
Yeah. Anthony, I wonder if you could just tell us a little bit about whether most of your clients have accounts elsewhere. Maybe you can clear that up for us. Are there other long-term assets and accounts sitting elsewhere, like ETFs, for example, or other kinds of accounts that are just not on your platform?
Yeah, it's so with the demographic of user, and I'm talking about traders, in the late 20s, early 30s, that are most prolific on our type of mobile first brokerage solution, like a Webull, like a Robinhood. It's very common for them to have multiple brokerage accounts and multiple relationships with different sort of tools. Because again, these are all mobile app based, right? It'd be different if we were back in the brick and mortar days, where it was a bit more common to have one specific asset manager down across the board, where they're doing your retirements, they're also doing your active trading, they may even be doing your banking. Those days are completely gone with this new Generation Z or millennial type of customer, right? They look for different platforms that offer better things for their individual needs, whether it's improving their credit score, whether it's free checking, free trading with access to options and crypto at the same time. And every platform does one thing a little bit better than everyone else. Now, everyone tries to create that one super app, right? But one size never truly fits all. And it's really easy for today's user to have multiple relationships and to manage those relationships easily. Minimums are gone, right? Minimums used to be a thing, or if you didn't trade enough per quarter, right, your account would be put in hold or put on lockdown. Those things no longer exist. There's no more minimums. There's no more expectations for you to have a certain amount of deposits per year or a certain amount of transactions per year. So it really opens up the playing field. And we're seeing a lot of our customers may actually be holding a lot of ETFs, especially in these robo-advisor platforms like a Betterment, right, or a Stash or an Acorns, where they actually are very ETF heavy in their portfolio, but on their active investing platforms like a Webull, they're more stock specific, right? They're taking those opportunities to create that alpha in their portfolio to get some incremental cash.
And not only
it's almost no different than cable, right? Than cutting the cord and doing streaming. Like you have the choices. Exactly. You don't need the bundle.
Disney Plus and HBO Max, and we have them all. We all thought we were going to save money by cutting the cord.
Yeah, and it's not only there's no minimums, there's no commissions either, right? You're not charging commissions, are you? You do payment for order flow, right?
We do payment for order flow. We do allow fractional trading. We allow options trading, complex strategies, calendar spreads, condors, no contracts, no contract fees, no commissions, no minimums, no monthlies. It's a no-cost platform to our customer, and we do make money on payment for order flow to monetize.
What I think is worth noting too is that this generation has a different appetite for risk from the bottom up. If you even look at the employment, we recently launched a private equity business, and what we're finding out is that there's so much more liquidity and things happening in the private equity space because the younger generation of employees, those reaching their 30s and 20s, exchanged equity in the company for lieu of a salary. And there is a ton of risk. And I'm working for a startup. I'm going to take 50% of my salary in equity and watch this thing go public in 10 years. That's happening way more than it did with the 40s and 50s and the baby boomers that are happening now. So they're just used to risk, and they're also used to being very educated about it. I think it's great what Webull's doing with all the education, the options.
Yeah,
there's so many more tools available now for the education.
Yeah, Andrew, Anthony was talking about their investors being on multiple platforms. So it seems like a lot of these young people have private equity exposure through their own jobs, for example, in new companies. Yeah. And that's a growing trend as well, right? Are you seeing that?
Yeah, that's what we're seeing, because all of a sudden, like all these companies, I mean, you'll hear about it. You guys have talked about it and say, oh, can I get into Palantir early and DoorDash and all these things? And this is why the SPAC's coming up, right? The popularity is everyone wants to get in now. They want to be like their grandfather's Goldman. He was the best account, so he got in pre-IPOs. That is not what goes on anymore. And the reason why there is liquidity is because you may have a 20-something that is a C-level executive at this company, and he has so much that he wants to get out. I've talked to these companies, and they're like, yeah, sure, we will let the CFO let go of $10 million of this company. He's been in it since he was 22 years old, and they get to cash out. That's a new phenomenon. Obviously, it's not related to ETFs, but it just shows you that, of course, they're willing to write a call, sell a put. That's nothing compared to they put in the entire risk of their career on one company. So they like to diversify. They do these other companies. They get involved early. They're not scared.
Yeah. Okay, gentlemen, I'm going to have to leave it there. That does it for this week's ETF Edge. My thanks to Anthony, Andrew, and Harry. We've asked Anthony to stick around for the ETF Edge podcast to tell us a little bit more about what Webull is doing with that 7 million customer base. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.